morning everyone. Today I'm up with a video that would explain you about how to go about in calculating interest and TDS demands and TDS requirements. So when we speak of interest would get attracted as per the income tax law 1961 if there is any short deduction of TDS, or if there is any late payment of TDS, or if there is any failure to furnish the returns on time. There are due dates that one has to follow, and if that due dates are not met, the 7th is the due date for payment of TDS, and if you end up paying it on 8th or 9th, then interest would get attracted. You have the due dates for filing of returns 31st of the month or the last day of the month subsequent to the month of the quarter. So if it is June, then it will be 31st July for the Q1 TDS returns, and if that due date is not met, then you would be facing with a penalty of 200 rupees per day for every day of default. And if that default is there, and if you fail to furnish or if you fail to pay that amount, then again interest would be attracted out as well. Here I have tried to explain about how to calculate the interest on TDS defaults or TDS demands. So basically there are three sections that deal with interest as such. Just I've given in this article of mine, which I've posted, or the link of which is posted in the comment section, is 201.1a.1, which is failure to deduct TDS. 201.1a subclause 2, which is failure to deposit TDS, which has been deducted, and section 220 subsection 2, which speaks about the failure to acknowledge the demand of tax. So this first section 201.1a.1 is that which deals with the failure to deduct TDS on time. The TDS section specify when a TDS has to be deducted. Generally, it is the payment or credit whichever is earlier. So if that criteria is not met or it is violated, 1% of interest on the TDS amount that was due to be deducted will be applicable from the due date of deduction till the date of deduction. Next is 201.1a subclause 2, failure to deposit TDS. That is, once after having deducted TDS, one has failed to deposit in the bank account or in the TDS by payment of challan to the government, then 1.5% of the interest shall be applicable from the due date of payment. In fact, it is from the date of deduction till the date of payment. And 220 subsection 2 speaks of interest at the rate of 1% for every demand which has not been met within 30 days of the demand being raised. So now we will look at, I've given sample scenarios on how to go about in calculating interest. Another two subsections or rules that one would have to know about is rule 119a. Is rule 119a, which speaks of rounding off of the default amount to the nearest 100, which is like, even if it is, say, the default amount is 780 rupees, it will have to be rounded off to 700 rupees. The next section is 288b, which is rounding off the tax payable to multiples of rupees 10, which is applicable even for normal income tax as well as for TDS. Therefore, the amount that would have to be paid would have to be in multiples of 10, which is similar to normal math rounding as such. We have three scenarios. This TDS amount in scenario 1 is 21,808, scenario 2 is 16,085, and in scenario 3 is 37,885. That is the TDS amount involved, and the due date of deduction is 11th April 17, 4th June 17, and 5th July 17. So if you take the scenario 1 as such, if the due date of deduction is 11th April 17, however, the date of deduction is 10th May 17. So the SSE has defaulted in deducting TDS on 11th April 2017. Therefore, the provisions of 201.1a.1, which is failure to deduct TDS, will be applicable. So if that being the case, the number of months for which it would be applicable would be 2, which is April as well as May. please do not count it as only May alone, or just for the month on which the amount or the deduction due date of deduction falls, and also the month in which date of deduction falls. Both the months have to be counted, and it is like, even if it is a part of a month, it will be considered as one whole month. So the number of months of default is 2 in the scenario 1. So we'll first handle scenario 1. So now we'll have to apply 119A, which is rounding off of default TDS amount, in order to apply the 201A 1% of the interest. For if you see this amount, it is 21,808. So after applying 119A, we get 21,800, on which it has to be rounded off. If the rounded off amount and rate of interest is 1%, so the interest amount that you would be getting is 872 rupees. This 872 rupees is the interest on failure to deduct TDS, therefore which gets deducted on 10th May 2017. Now what has happened? After having deducted on 10th May 2017, the due date of payment of TDS becomes 7 June 2017. Now let us look at the date of payment of TDS that has happened on 10th November 17, which means that which was due to be deposited on June was deposited in November. So if you calculate the number of months of delay, it becomes 6 months, which means June, July, August, September, October, and November. 6 months. Again, we'll have to calculate the interest at 1.5%, which means there is a default as per in accordance or in violation of the rules of TDS. That is, one has to deposit within the 7th of the next month. So there is a failure to deposit TDS, and the amount of interest that has to be calculated will be at 1.5% per month. So we have 6 months of default, and here the interest amount or the amount on which interest has to be calculated would be on 21,800. 6 months, you would get 1962. That is as far as scenario 1 is concerned. If you look at scenario 2, 16,085 is the default or the TDS amount involved. 4th June is the date of deduction and the due date of deduction as well. Therefore, the deduction has happened on time. Now, if you look at the due date of payment, it is again 7 July. But what has happened is it has happened on 10th October 2018. So there is a default of more than 16 months, that is from July 17 to October 18, both the months inclusive. So you would get a period of 16 months in between, and then amount on which interest has to be calculated is not 16,085 to be rounded off to the nearest 100, so it will be 16,000 only at 1.5% per month. Therefore it will amount to 3840. 16,000 into 1.5%, 16,000 into 0.5% into 16, 3840 is the amount of default. Now if you again go over the interest amount for the defaulted TDS, you go to the next scenario, it is 37,885, and it has been deducted in the month of July of 2017 is the due date. However, 25th December 2018 is the date at which the deposit of TDS has happened. So from August 17 to December 18, it will be from August 17 to July 18 will be 12 months plus August, September, October, November, December, which means another 5 months will have to be added. Total number of months of default 17 months. So 17 months of default has happened and the rate of interest will be at 1.5%. If you look at the default amount, it is 37,885. It is 37,885 will have to be rounded off to 37,800 to 17 to 1.5%. So we will get an amount of 9639 is the amount that has to be paid. Now the total interest that has to be paid is obviously 201A 1 subclause 1 plus 201A subclause 2, which would be 2834 in the case of scenario 1. In the rest of the cases, it will be just the 201.182 defaults. Therefore, it will be 3840.9639. Now we will have to apply, while deposit of tax to the government, we will have to apply section 288B, rounding off of the tax payable. So we know very well that 2834 is the amount payable, but then it has to be rounded off. So therefore 2834 will be rounded off to 2830. 3840, there is no requirement for rounding it off. And 9639 will be rounded off to 9640. Now this concludes the calculation part of 201.1a and 201.1a2 for failure and to failure of deducting TDS and late payment of TDS. Now we will come to the case of calculation of interest under section 222 or 220 subsection 2 as such. Now here the date of payment of TDS was 10th November 2017. The same scenario has been continued, that is from 10th October 2018 and 25th December 2018. What has happened is amount paid was only the basic amount, which means the interest calculation was not done at the time of discharging TDS on the above dates. Therefore 21,808, 16,085 and 37,885 was only paid without adding interest to it. Now what has happened, once having paid the TDS and having corrected the TDS returns, intimation has come up to the SSE stating having a demand of so and so amount, which would probably be the interest amount due till the date of payment of TDS, which is till 10th November 2017 in scenario 1, 10th October 2018 in scenario 2, and 25th December 2018 in scenario 3. So the date of issue of notice or the intimation was on 13th November 2017. Therefore, remember, unlike your normal regular return of income, where it takes around 3 to 4 months for processing of the income tax returns, TDS returns gets processed very quickly. Sometimes it will be processed within a day, and you will end up facing a demand as well. So I will come to the later part of that and precautions to be taken. So for the date of issue of demand is 13 November 2017 in scenario 1, 13th October 2018 in scenario 2, and 31st December 2018. Therefore, if you just see that, we can assume, or we have assumed, that our correction has happened immediately. Therefore, the notice has also come up very soon. Now what has happened, this is a demand under section 156. 156 is any demand which has been raised by the income tax department. The time allowed under section 156 is 30 days from the date of raising of the demand. So if you see, the due date of payment of demand would be 30 days plus date of issue of demand, which means 13 November 2017 plus 30 days. So you will be getting 12th December 2017, 11th November 2018 and 29th January 2019. Why is this date relevant? Because the demand has to be discharged within this date. If not, 220 subsection 2 interest will be applicable afterwards, which means one would have to pay 1.5% on the basic TDS amount for failure to pay the TDS, 1% on failure to deduct TDS, and again 1% on failure to pay the amount demanded by the income tax department. But totally it will be around 3.5% interest per month, which means it would amount to 42% interest per annum. So this is how the interest provisions have been framed, very harsh on the SSE, but anyway, one has to face that. If he is going to take on, or if he is not going to comply, this is the punishment for non-compliance. So amount demanded is the interest amount on the date of payment, which we have calculated above. This is 2830 in scenario 1, 3840 and 9640. So now what has happened is that this SSE has slept on the demand. So he has neither corrected the TDS returns nor has he paid the demand. Therefore, and now he has realized and he has paid the demand on 11th November 2019. So from 2017 to 2019, there is almost 2 years delay in scenario 1. For the number of months of delay would be calculated from December 17, November 19. That comes exactly to 24 months. And in the second scenario, it comes to 25 months, I guess. No, sorry, it is 11th November 2018, therefore it comes to 13 months. And 29 January 2019 to 11th November 2019 will be 11 months in case of scenario 3. Again, we will have to go to the 119A rule for the purpose of calculating interest. 2830 will have to be rounded off to the nearest 100, which will be 2800. 3840 will have to be rounded off to nearest 100, which will be 3800. 9640 will have to be rounded off to the nearest 100, which will be 9600. Amount of interest under section 222 would be 672 in case of scenario 1, which is 2800 into 24 months into 1%. 672, 494 in scenario 2 and 1056 in scenario 3. For amount of interest under section 222 to be paid, you can say 672 will be rounded off to 670, 490 and 1060. Total interest is 3500, 4330 and 10,700. That is the methodology for calculating interest under section 220 subsection 2. Now I have some word of caution is that interest under section 222 will be applied only in cases where the interest under section 201 1A are not applicable, which means when there is a demand of basic TDS amount, there will not be any application of 220 subsection 2, which means one has to pay for any basic amount which is outstanding and which remains to be paid. Automatically the provisions of 201 subsection 201 1A subclause 2 will be applicable, and 1.5% of interest will have to be paid to discharge the amount. However, if a person fails to pay the basic TDS amount or fails to pay the interest and has only paid the basic TDS amount, then interest demand will be raised under section 201 1A, on which 222 will be applied, which means there is a portion of interest on interest which is there when one has defaulted in payment of the basic 201 1A interest as such. The other provision is that 234E late fee will also attract 222 interest as well. Therefore, the late fee provisions are very harsh as such, with 200 rupees per day to be paid. For when that being the case, if there is an interest of 1.5% on 1% on that amount, it will again multiply and it will be a huge problem or concern for the assessee. That's what I've written, that one stands to lose more if there is interest demanded other than TDS demand, and whenever TDS demands exist, it's safer to settle with interest. Further, even though the provisions are applicable for the defaulter to avoid payment of TDS amount, so the 201A 1A provision provides that a person can cannot be treated as an assessee in default if he is producing evidences that the TDS has been paid by the deductee and by producing his income tax returns along with a certificate of a chartered accountant. However, he will not be excused from the payment of interest, for interest shall always be compulsory. In such cases, interest shall be calculated from the due date of deduction till the date of furnishing of the return of income by the deductee. Therefore, there is no escape in payment of TDS because the default still lies with the default deductor. Hence, what is the advice over here? For whenever regularly you are filing your TDS returns, kindly ensure that you visit the TDS CPC website and in the default section and find out if there is any default or any demand raised by the CPC or by the assessing officer, and if there is any, kindly settle it at the earliest because the because it is for the purpose of saving your cash flow and the cost to the company. It's always better to comply. If not, at least have a track of your mail ID for any of the communications received from your income tax authorities, so as to see whether the TDS returns have been processed without any defaults. Last but not the least, remember the cost of compliance is always cheaper than the cost of non-compliance. Thank you.